Ed Egilinsky joining us, Managing Director, Head of Alternative Investments at Direxion. Ed, good to have you here this Friday. Thank you. Is what we're seeing a delayed reaction to the recent OPEC meeting, possibly helping crude regain its footing here?
Next key level, Ben, is around the 83, then 85 level to push higher. But the trend is certainly bullish right now. You know, after the OPEC meeting, crude consolidated a little bit, drifted down. But then I think when people reevaluated what OPEC said, that those voluntary supplies coming back into the market may be a little longer than anticipated. So that alleviated some fears. But the biggest thing, Ben, that's been really keeping a risk premium or a floor on crude has been the geopolitical risk. And there's been some renewed unfortunate risk, both in the Middle East as well as Russia with the drone attacks just last night by the Ukraine. So when you look at right now, inventories as well, last week they unexpectedly dropped. And supply-demand balance is expected to tighten in the third quarter for crude. So yeah, you have some bullish signs here right now.
You sure do, and a lot of people calling for this commodity super cycle to, at some point, kind of regain some of that momentum to the upside. We've seen copper prices, metals come off a little bit, but geopolitical tensions, to your point, inventories contributing to the rally, right? Does this imply, do we expect to see, do you look for higher commodity prices? Do you think the super cycle's in full force here?
Well, even despite the CPI and PPI numbers most recently, which shows that inflation is cooling a little bit, inflation is still persistent. As a result of that, commodity prices should remain elevated. And if you do get a Fed rate cut, Ben, that's probably going to be good in terms of the dollar weakening, which should benefit most commodities. The other thing is, everybody's talking about the strong labor market. I think it's a little deceptive in terms of the jobs added. A lot of those jobs being added are lower income jobs. So you could debate on whether or not those job numbers are as robust as people are saying.
Ed, talk to us a little bit about natural gas prices recently coming off, what was it, around 315, 320 area, back down to 270. But as you take a look, kind of just retracing a strong rally similar to what we were talking about throughout the month of June, where natural gas prices basically rallied. We're talking from, what was it, around 280, it looks like, end of May. Around 240, 250 around end of May, up to that level, as mentioned, around 315. So, and even as I look here, I think this is the chart I wanted to pull. Yeah, natural gas. Look, I mean, bigger picture, you can see we've seen a significant rally off below $2.
Yeah, I mean, you were up 30% alone in May, Ben. But right now, if you look at the technicals, natural gas is at a critical level here. It couldn't hold that 280 area, 280 to 285 area. I think it broke a little below last night. So maybe you'll see about 250 to 260 before the resumption of a potential rally. But all you have to do is look at whether it's Chicago or New York. I know you're based in Chicago. The hot temperatures across the U.S. right now. That's where natural gas is going to get some traction, and you're continuing to see hotter weather throughout the U.S. Of course, that'll mean an increase in electricity needs for utility providers, and AI and big data. Ben, you talked about NVIDIA. Natural gas is going to be a continued big player in that, and that's not going to go away. What's interesting also is right now Europe is stockpiling natural gas as a result of not being able to rely on Russia for supply. And then I think it was just yesterday, China going to curb and regulate natural gas usage to adopt that. So there are a number of tailwinds right now for natural gas, but that 250 level is going to be key for natural gas to hold.
We'll watch 250. Ed, we were talking before the break about gas prices, or during the break, kind of joking around about this one station here in Chicago, which is traditionally just way over the top. I mean, in terms of prices, right? It's probably, we were joking about $6 right now. No joke. I mean, definitely over $5. And
is that where you fuel your Maserati?
I'm, no, I'm looking at this AAA. According to them, the national average around 345. We're coming off, it seems like, a month ago, 360, a year ago, 358. I mean, gas prices relatively tame. Talk to us about commodity sectors in general, and where do you see some of the opportunities as we head in the second half of the year?
Well, it's interesting. If you're talking about gasoline, just for 1 minute, Ben, jet fuel's definitely the demand's up. Gasoline demand is about a little less than last year at this time. As you mentioned, the average price of gas is down a little bit from last year. But keep in mind that it is an election year.
Mm-hmm.
The political implications on the direction of gas prices, and they are releasing strategic petroleum reserves this summer to help keep prices down. So it'll be interesting to see what happens with gasoline. And also the wild card always is the weather and potential hurricanes are coming into that season. In regards to your question, best opportunities for the balance of 2024, certainly the metals still come to mind because if you get a risk-off environment and the VIX starts popping, you got to believe that flight to safety trade with gold and even silver to a certain extent, might continue that rally there. And also, if you get rate cuts, it's going to weaken the dollar. That should be beneficial to the broader commodity markets, but especially the metals. They're most sensitive to dollar strength. So a weaker dollar should help the metals in general. But, Ben, that super cycle, what's going to trigger that still? The lack of CapEx spending, the continued geopolitical risk, ongoing supply concerns, and the word stagflation. I don't know if that's going to come back into play, but the lack of growth, still higher inflation, I think that can come into play as well.
My gosh, a while since we heard about lack of CapEx spending, but definitely a factor to consider. All this having been said, Ed, talk to us about how the Direxion COM ETF is currently positioned to take advantage of some of the opportunities you just mentioned.
Well, the COM ETF a little unique. We're long 6 out of the 12 commodities right now. Crude oil and gasoline among them, the 3 metals, copper, gold, and silver that we cover, and then just most recently wheat. We're long a commodity if it's showing a favorable price trend, in cash with the commodity if it's showing a downward price trend. So when you look at it right now, we have about 50% exposure to those 12 commodities, being long 6. And right now, if you're in cash with certain commodities, you're getting paid to wait with where yields are right now.
Recently running into some resistance up around 30.60, it looks like, but still holding up near the upper third of the range that we've been in over the last year or so. Ed, appreciate you sharing part of your Friday with us here on the network. Ed Egilinsky, Managing Director and Head of Alternative Investments at Direxion.